Just wanted to thank everybody for coming today. We're going to go ahead and get started. Thankfully, I have a few minutes to introduce myself and Delta Private Jets. This is our first year getting to participate. We're really excited. It was great being able to speak last night and say hi.
My name is Michael DeVito. I'm a partner at Mazars USA. I'm delighted to be here. We've been involved with VCs on skis for many, many years. I want to welcome our panel, exploring the current state of cryptocurrency, ICOs, and blockchain ecosystem. The last 12 months has been a roller coaster for cryptocurrency. 2017 saw Bitcoin rise from 900 to 20,000, which is over a 21-time increase, only to drop below 7,000 by February of 2018. Last year also saw the emergence of new cryptocurrencies, ICOs as an alternative to venture capital, and the furtherance of the blockchain as a secure distributed application platform disrupting many industries. This panel is going to provide some context for what happened in 2017 and what we can expect in 2018. Our panelists will explore the applicability of cryptocurrency as a viable option to fiat, the future impact to capital markets, and technical considerations around the blockchain as a component of the tech stack. I'd now like to introduce our panelists. Tom Garamboni is a founding partner of Tetris Capital. Tetris Capital is a New York City-based hedge fund focused on blockchain and crypto assets. Tom started his career in the financial sponsors investment banking group at Deutsche Bank, where he worked on leveraged buyouts, acquisitions, and financing of mature software as a service, data centers, e-wallet, and security companies. Johnny Dilley is a systems architect who prioritizes resilience under adversarial conditions and solves problems where others have given up. He was employee number 1 at Pantera Capital, where he built numerous investment theses resulting in over $1 billion. In addition to overseeing a venture capital arm, most notable investment was Corbett, which recently exited for over $160 million. He was also employee number 1 at Blockstream, where he architected the recently announced data feed with ICE, which is a New York Stock Exchange parent. Johnny is also a Bitcoin core contributor and is the primary author of the Strong Federations paper. And most importantly, we appreciate you flying from California, so thank you.
It's great to be here.
Thank you. Renee Van Kesteren is a senior advisor at BlockFi, a startup that makes loans against crypto. At BlockFi, Renee helps design and manage the company's pricing, collateral management, and liquidation models. Since 2004, Renee was at Bank of America Merrill Lynch, where he most recently was a managing director in equity markets. During his time there, he built the equity structured lending platform, including risk and regulatory compliance frameworks. David Madden is the business development director, hedge funds at Trident Trust. Trident Trust is a leading independent corporate fiduciary and fund administrator, employing nearly 800 staff across a global footprint that spans Africa, the Americas, Asia, the Caribbean, Europe, and the Middle East. They provide a comprehensive range of services to almost 500 hedge funds, private equity funds, and real estate funds that are in excess of $35 billion. Scott Rosenblatt, a good friend of mine, is a partner at Wright, Callis and Rosenblatt. Scott represents both privately and publicly held companies in a wide variety of corporate matters, including mergers and acquisitions, private equity, venture capital, business reorgs, capital markets, and joint venture transactions. And finally, I would like to introduce our moderator, Christina Dolan. She's the co-founder and COO of IX Ledger, an MIT Media Lab alumna and internet pioneer with over 2 decades of experience building software, internet, AI, and fintech-related businesses. Excuse me, she was a co-founder of OneMain.com, which grew to be the 10th largest ISP after a successful IPO, which was acquired by Earthlink. Formerly, Ms. Dolan held executive roles at Disney, Hearst, IBM, and Oracle. She's a member of Ford's Technology Council and the vice chair and former chair of the MIT Enterprise Forum in New York, where she hosted several blockchain and fintech events with industry leaders. Christina, I turn it over to you. Thank you.
Well, very excited. Can you hear me? Very excited to be here. And we have an amazing, amazing panel here that's going to give you some insights on this very frothy crypto market that you hear so much about. As you've heard, you have a really amazing panel that has actually participated in this fire hose of learning that took place in 2017. And I'm hoping that they'll share with you a bit of the knowledge that they acquired through that very what I'd consider to be exciting process, and kind of share with you where things were last year, where they are now, and kind of where they should be for next year. So maybe start off with, I think we should start off with a sort of a description of, what blockchain is versus one of these cryptocurrencies or an ICO. And I'm wondering who wants to take that, either Johnny or Tom or...
I'll start a little bit softer, and I'll go with So Bitcoin was created with the goal of essentially disintermediating governments' rights to infinitely inflate away a population's wealth, which is what they do. Which is what they do with fiat money. Let's cut to the chase. So it has a that is its purpose, essentially. You can argue about whether or not it's succeeding in that purpose or whether or not that's actually what it does, but that's essentially what it was created for and like what its creator was striving for. ICOs, the vast majority of them are a means of transferring wealth from one party to another. But for some of them, they're also a way for individuals and companies or enterprises or people striving to be those to acquire the capital required to build what in a lot of cases are elaborate, seemingly sophisticated and difficult, complex infrastructure challenges. And a blockchain is useful in one case and one case only. It is, not all ICOs are blockchains, but a blockchain is useful when you have many competitors who must, under certain conditions, be counterparties with one another. And if Bitcoin teaches us anything, it's that in a world where digital ownership is actual ownership, you can't really trust your counterparty until all the money's been settled and all the nuances of a contract have played out. So in trade finance, in trade, and in any aspect where a competitor has to, trust someone with a digital piece of information, a blockchain facilitates kind of enforced mechanical rules of governance that make it so that essentially no one's allowed to cheat unless everyone's cheating.
So Tom, you had some interesting insights in the difference between sort of like the early coins like Bitcoin and then the Ethereum, which also was an ICO.
Yeah, so I'll abstract off that a little bit. I think the term blockchain is now being used to describe a lot more than like what its actual definition is. Like the blockchain, its name itself is a block of data. In the case of Bitcoin, it's about 10 minutes worth of transactions data put together, and then the next block actually points back to it. And so you have these blocks of data that, since the beginning of Bitcoin invented or started, you could see everything that's ever happened. Now, so I guess what we're talking about is cryptocurrencies. It doesn't necessarily have to be a blockchain, but what it is, I guess, is digital scarcity. There's several ways of achieving that. A blockchain term has been abstracted to kind of cover everything. So as Johnny said, Bitcoin, it fundamentally started as a political movement, but what came out of that was this really open source, open system way of creating digital scarcity. Before that, digital scarcity had actually existed, and it gets earlier into the protocol days of the internet, into like IPv4, IPv6, then you go into DNS as well. And so there's actually comps into digital scarcity having any value. I think IPv4 addresses right now are worth between like $10 and $20. There's like, was it 4 billion of them? So the internet of IPv4 is worth about $40 billion. And then, so the idea of Bitcoin got everybody really excited about kind of where we can go with things in this open system. And so like IPv4 had to be kind of rooted in hardware devices. Bitcoin invention was able to produce digital scarcity not in any location, not in any hardware devices, fundamentally in software. So we had this hype kind of from 2009 to 2014 and peaking in 2014, and peaking really when people realized that it was hard to do a lot of things that, or where we were in the development of this digital scarcity process was not as far as where people thought. Everybody thought they could reinvent everything. They could take down Facebook, Amazon, Google, and so that was the first bubble. And now I guess we're having the second bubble, and now just everything being tokenized and digital scarcity. And so I guess working off your question then, Ethereum was really, I think, really started this whole boom of ICOs. So really it's hard to build things on top of Bitcoin. Bitcoin is really good and intentionally really good at being very inflexible and just being money. Ethereum was made in 2014 purposefully to be pretty flexible. And so really what it's turned out to be its main use case is building ERC20 tokens on top of it. So building digital scarcity within the Ethereum blockchain. And so that really gave everybody for the first time the ability to kind of do your own ICO. And so that's why now we have about 1,500 tokens that are above like 10 million right now.
So now you've distinguished the difference between blockchain and coins that did not have an ICO, and then coins that had an ICO. So Scott, can you sort of explain what an ICO is before we get too far along?
Sure. So initial coin offering. You need to get a number of these coins out there for the system to be viable and for parties to create either the usage in the context of utility tokens, which I assume we'll get into later on, or any kind of meaningful exchange that sets a value. So how do you get these tokens out there? And this is the common method for creating wider distribution. So there's a holding amongst enough parties to make it viable currency in this case.
Okay. And so, so how is it that people are using this as a funding mechanism?
Well, if you sell the coins after they've been minted, and I guess we can get into the point if people want to hear about the regulatory complexities of doing it, but you can raise the funds from selling those and then use that to the development of the network, which then in turn is in the case of utility token, what the coins are used for to purchase a service or a product. And then the proceeds are used to develop that by the company. So as opposed to going out to the equity markets, let's say going to a venture fund and raising capital, selling your equity, this is an alternative method which would raise capital for the company that's the issuer of the tokens. So it's aside with a completely different system, and it's debatable whether or not it falls into the same regulatory regime and adding to the complexities, or it's a whole new method that should really be separate and aside and not have the same restrictions.
Okay, so now we've covered sort of what the initial coins. Then we talked about these tokens that are part of this whole ICO craze, and we have a description of what ICOs are. So, so let's get into a little bit of what 2017 was like. I mean, from my perspective, I thought it was like a fire hose of constant discovery. But you know, if we could start from Tom and sort of say a little bit about what was your journey into this, and you know, what was your view on 2017?
Sure. So I really started getting interested in Bitcoin in 2012. After leaving college, ended up going to Wall Street. There wasn't a blockchain industry to go into, and so the blockchain industry really started, I think, developing. I think in 2014, and then 2017 has been now where it's actually hit the public consciousness. I think, as I said before, I think Ethereum is probably mostly responsible for that. So. Giving accessibility to people to create things, whether those things are worth anything or not, it's putting the idea of innovation directly in people's hands, and so people have taken that and run. Kind of Bitcoin. It's kind of funny that this boom now has then trickled a lot of value into Bitcoin, and so you have this wave of talent that's come in being interested in Ethereum, and the idea of Ethereum being more flexible and you could build things, and then realizing that Ethereum has some downside faults that actually Bitcoin is better at, and so that's why Bitcoin didn't transition into a lot of those things. And so I think when this really all started happening was actually around March in 2017. Ethereum, so it got started in 2014. The actual token started trading in 2016. It was then added to Coinbase, and then it's most importantly added to Coinbase and accessible for residents in New York in March of 2017. And there was some conference around that time, and then it was kind of like spreading like a virus of everybody finding out what this was. So then you had this slew of people being interested in, number one, doing ICOs and and kind of having their own projects than to raising money to manage funds for cryptocurrencies. And so I ended up doing the latter. And so
How easy was it to get people to work with you on that?
No, so there was like two
Like
or three.
Dave over there.
Yeah, there are 2 or 3 funds that had started, I think, before us that gave us some precedent. But I was shocked and a little bit afraid or excited that now all the things that are normal that funds have to do is a little bit different here, but there weren't really clear precedent security guidelines. And so you have to be fairly comfortable with this gray area, number one, legally, and two, security and the infrastructure. I think what everybody's realizing now is still very much like early innings. And so now I think we have this third wave of like real business people getting involved to build in middle layers for just infrastructure layer stuff. In a lot of ways, it feels like this market has reinvented itself, and we started back in like the 1970s, and like I think we're like 1990s type markets.
Yeah. We've gone through at least 2 phases by this point.
So, Johnny, why don't you share your journey?
Born in 1970.
No, so David is our fund admin, and so I think we sat down in May or so, 2017.
So, Dave, why don't you share what that journey was like? Because I know that having been a co-founder of a company that was in the space, anytime you talk to a bank or any sort of a service provider, the first thing they say, you say crypto, and they say, what? No, get out of here. And so...
Oh, absolutely. So some of the first calls that we actually started receiving were just some young kids coming out with a few $1 million that they were running for their family saying, hey, we're going to invest, we're a hedge fund. And the answer, I would ask them, well, have you spoke to a lawyer? And the answer was, why? Why do I need that? Why do I need to speak to a lawyer? I got my friends and family's money. The answers were like, whoa, you can't do that. You need to take a step back. So the initial kind of hedge fund or managers at the time were very unsophisticated. So started with those, and from our perspective, I'm a traditional kind of finance guy coming from the hedge fund side. To hear these guys buying Bitcoin and even listening, what's blockchain? It's very complicated, and it's a whole new world. I'm buying Bitcoin, I'm buying Ethereum, I'm storing them on these little keys. From a finance perspective, it's like, what are you doing? What is Poloniex? What's Coinbase? Who's GDocs? So it's a whole kind of new lingo that was out there. So from a service provider perspective, the first couple of managers we saw, we would say, kind of neat, but not really interested. The more you started speaking to them, the more it was like, hey, these guys are on to something. They believe in it. You look, I say, whether I believe in it, whether my manager, whatever, it doesn't matter. These young generation, these guys do believe in this kind of ecosystem, this world, this coin, this future. From a service provider perspective, we had said, hey, let's get involved. Let's be part of it.
Well, how about those people who call, and when you're in the space, you get the strangest phone calls, but you have these people that say, oh, I have $100 million worth of Bitcoin, or I have $100 million worth of Ethereum, and I'd love to talk to you about investing it. And of course, what is the response when they can't tell you where it came from?
Oh, that's still, and that's a very big issue. That's what's called in-kind contributions.
Yes.
And we get a lot of managers that say, hey, I've got $5 million worth of coin. And our firm will say, no problem, we will allow it in, provided you could tell us the source of the funds. And we've gotten pretty senior managers come back and say to us, oh, we can't do that. We've held it for too long. It's bounced around exchanges for far too long. And so the answer to something like that is absolutely no way can those funds enter any of the hedge funds that at least we're servicing. I don't know. It's a very, very hot button, and it's a big question for a lot of managers.
Yeah.
So, Johnny, sorry, will you say something?
No.
Because I was going to ask Johnny's perspective, because he's also been in the bowels of all of this and seen a lot of interesting aspects of this.
Yeah, so fundamentally, this is kind of a question that has to deal with how compliance deals with or how client or client-facing compliance deals with an asset that's truly fungible. And fungibility is fundamentally what underwrites a lot of things that have and hold value. So cash is fungible because everyone accepts it because you have a reasonable expectation that the $100 bill you're being handed is equivalent to every other $100 bill that's been issued. The same, except for the serial number, but no one looks at the serial numbers. The same is true with bricks of gold, kilograms of cocaine, the land outside your place in Sun Valley or whatever. Essentially there's a certain type of value set where because assets are interchangeable and assets are the best way I've put it is from that which they came, they remain. So land is always land, gold is always gold, dollars are dollars unless you destroy or shred them. The same is true with Bitcoin. And this kind of flies in the face of the last, I want to say, 600 years of financial infrastructure, in the sense that everyone likes, when they account, to know where and whom their assets come from and why they came from them. And in fact, it's gotten so deeply pervasive in the financial infrastructure now that it has to do with everything. Everything that anyone touches everywhere it has to be logged and known, and the price paid. And the systems we're talking about, because ownership is key mediated, which means that I can walk up to Tom and I can be like, "Hey Tom, I got $100,000 in Bitcoin. You got $100,000 in cash? Oh, cool!" And we can just transfer peer to peer. It kind of undermines the ability for contemporary financial regulations and contemporary regulators to actually understand when a transaction is an actual transaction. Because I can send $100,000 in Bitcoin to myself 100,000 times, and you have no evidence that I haven't just traded it to myself, or has it participated in a bunch of dark market exchanges. You have no insight into it, because the way the systems are designed is to enforce fungibility, because the creator of the system cared about making a money, not something that caters to the whims of financial regulators. I would philosophically say that this is why it's interesting and valuable for humanity, is because we need a strong money. Because without a strong money, what ends up happening is your economy ends up devouring itself over time.
Well, that's a good point.
That's a philosophical point.
I'll add the. So it's I think where the funds that I've seen are just individuals in the space who are going to, I think, see near-term success and then long-term success. If you're going to be long-term greedy, you have to play in the existing system rules, and so that's definitely possible. And so I think what we're actually seeing now is more so of like whitelisting addresses for Bitcoin, and so I think that's probably going to be a very large upcoming trend. And so people have like kind of fully realized that Bitcoin being fully traceable, it does work with the existing parameters in the system, whereas like the more dark market type stuff has moved elsewhere. So like coins like Zcash or Monero, which are focused on privacy, that's actually where the dark market activity now. So the connotation for Bitcoin being used for all this illicit behavior has kind of been lifted lately. You'll still find like bad press every now and then, but the person writing it is generally misinformed. So yeah, like what we've done, and like all three of the managing partners all have backgrounds in finance and private equity. I think we saw that to be long-term greedy and have success and want this system to be successful, is you have to conform to existing like rules and regulations. And so yeah, the whitelisting of addresses in Bitcoin has become like the theme and where things are going. And so I think that'll probably continue. And so in terms of like us accepting money, it's like and all the other funds that are successful, like everybody knows whose money is where and like whose money they're managing and stuff like that.
So in talking to the panelists, I mean, Renee, you had some thoughts because you came from a traditional background, and now you're in peer-to-peer and sort of a little bit of a different perspective.
Yeah, so we heard a bit about the infrastructure and sort of the censorship around it. There's actually even probably maybe more components around it. In a traditional framework, you obviously don't have this peer-to-peer irreversible transactions. Normally there's a clearing and settlement cycle, and all the middle office in a bank or in a broker-dealer are built in the middle office. Credit checks, compliance, risk management, and things are a bit more reversible. Here it's not. So you can imagine in a traditional hedge fund, if an asset manager manages 100 million and he calls up Jeffries, his prime broker, and says, hey, can you wire 10 million to my Cayman account? Jeffrey says no, right? No effing way. But obviously in Bitcoin and cryptocurrencies, the trader is both the middle office and the operations. He can just do it, right? And it's that's obviously a bit of a challenging aspect, and I would imagine if you need to strike a NAV, that's not trivial either as a fund administrator, because you rely on the manager representing you. Hey, you know, these are the addresses, this is all the money, but who says he has a couple other addresses?
The new trend now, well, just by nature of you being or having to be SEC regulated, you have to have a qualified custodian.
That's
so,
because you're an ICOs, right? That's why you need to. No. Because if you stick with
no,
the
just by, so like in New York State, the threshold's a little bit lower. So say AUM of 25 million. Elsewhere, it's like, is it 120 or 200 for
150.
assets? 150.
Right, yeah.
So just by nature of having that AUM size, you have to be SEC regulated, and within that framework, you have to have a qualified custodian. And so that means just a third party is just managing the moving around of assets. And so we've already gone through the process of, what's actually weird is that we can never fully be third party managing of assets just because they actually don't have the infrastructure to do this yet, but we could have about 85% of our assets being held by third parties. Yeah, I mean, that's also just for
and some of the
security.
beauty of that too is, from an administrative perspective, we monitor that. So when our managers come in, we have access to all of their keys, or all of their API keys into the exchanges. So we know what Tom has and what's going in and out. At the end of each day, we pull in all the trades from the exchanges, and based on that, we're able to produce the positions and transactions. But if he shoots a coin out from the Coinbase, we'll be able to see that. You know,
But doesn't that introduce a level of risk that doesn't exist in traditional markets?
Yeah.
Yes.
Oh, yes, absolutely.
So that's probably the largest reason why you haven't seen this inflow of institutional
that's right.
capital yet. It's
No one's
just-
figured out custody
It's just, I mean, this is the largest thing so the number one thing that I'm concerned about at any given period of time is security. So with securities is custody. And yeah, it's just a risk that institutions haven't ever really had, and if they have had that risk, they've been able to get insurance on that, and so there's just no insurance on this market. So it's I think when you have qualified custodians that could do it on a grand scale with insurance, that's when the real institutional money is going to come into the space.
Well, and so part of it is security. We can talk about it a little bit. So for the longest time, if you were a fund administrator or you're a fund manager or you're part of a family office or whatever, if you manage those balances on the behalf of your client base, like you said, if shit goes tits up, you can rewind the system, or you can back it out to the point where if there was fraud or malfeasance, you might be able to rewind things to the point where there wasn't fraud or malfeasance. But in a world where key ownership is digitally mediated and there are no recourses for that, how do you, like for example, if you're a bank, how do you know that your CTO isn't incentivized by the fact that he can walk away with $100 million in Bitcoin? Oh, I just lost it. They're gone. Sorry. Like, the system failed. Like, we thought we had backups. We thought our security audit was good, but it's just the money's gone. What? What are you talking about? In a normal securities world, like, you're going to be able to find that money or be able to back it out or eventually find him when he tries to move it. But in a Bitcoin or a digital currency world, there is no recourse.
And share too, just something as simple as transferring tokens or transferring Bitcoin from one wallet to another. If something as simple goes, something's typed wrong, coins are gone. There's no rewinding where, for example, a Fed wire, you might go to the wrong bank. You could call the bank and say, hey, I got some money that hit an account. Can you send it back? You do it with Bitcoin, it's gone. There's no rewinding on that.
Yeah.
It's part of the system is that it's about, or initially it was about being able to trust yourself. Like, you don't want to, like, the whole point of disintermediating settlement and middlemen was to empower yourself to have your own balances and have your own money. And that's, on one hand, terrifying, because if you lose your life savings, you've lost your life savings and there's no recourse. But on the other hand, it's empowering because you are your own bank. Now, that's not to say that you can't trust certain calibers of people with certain amounts of money. Like, that's part of how we work in the contemporary financial world. But if, for example, you trust the wrong person and they don't do custodianship well, you will lose your money.
Yeah, I mean, how the current system that we live in operates is there's just a large amount of trust on third parties. And so where Bitcoin is right now is we're still at this base layer, which is like pretty much, for Bitcoin, its base layer is pretty much done being developed. And now we're working off of that second layer and other infrastructure. So like I guess my prediction, or where I see this going, is we're going to adopt a lot of the existing infrastructure of like third-party custodies, clearing houses, but you'll always have the ability to go peer-to-peer. And so it's that ability to go peer-to-peer and not have to deal with the trusted third parties that gives it like its decentralization aspects. So if there's ever any problems with third parties, you always have the ability to opt out. So
Well, I will tell you from an administrative perspective, we just started reviewing that, and the peer-to-peer, we're not comfortable with.
Yeah.
Because we're gonna say, who's on the other side of the transaction?
Yeah,
So
exactly.
literally, these, what's now called decentralized exchanges are coming out.
Oof.
And
Yeah.
they're,
Yeah.
you know, we at least have steered clients away, saying, until we get more comfortable with that,
And
you can't do it. And that will evolve over time, but.
that's why I think something like whitelisting addresses or publishing like this address is mine is something that's inevitable.
How do you, that's enforced with multisig, so
No, so like, so Tom's talking about how, so if you think about it, Bitcoin is it's not dumb, but it's very brute force at the base. It's literally about being able to simply send an amount from an address to another person, and then everyone validates that occurs in a legitimate fashion. But second and third order infrastructure on top of that will allow more complicated structures, like contracting schemes where, for example, 10 funds or 100 funds and a couple of banks can all participate in the same kind of, you can think of it as a super glorified Excel spreadsheet on top of Bitcoin, where the balances of Bitcoin amongst the participants in that glorified spreadsheet can now rebalance amongst one another in a fully compliant fashion.
That's kind of what Coinbase is.
Coinbase is like an example of that inside a single institution, whereas the Lightning Network is an example of that involving multiple parties.
Yeah.
So it's interesting. There were a couple people who were invested in ICOs. I've gotten a couple people have called me who have invested in them, and they received their tokens, and they send them to the wrong address and burned them, and then asked me, how can I get them back? And I tried to explain, you're not.
So this is what's interesting is, and this might irk some people, but so you do have recourse when you're talking about institutions who you purchased something through. So think about it, Bitcoin's like this mercurial beast. No one really understands it. There's no leader. There's no leaders. There's no one who really even has any particular kinds of influence over the system or its direction. But when you're talking about, for example, a brand new ICO who's just recently launched their protocol, and the developers themselves still run the majority of the network, those are people in control of a system. You can send them a subpoena and say, if you don't give me my money back, I'm going to send you to jail. Like, those are people who, under certain conditions, can actually change a protocol to return you your money. So I actually don't think that that's the case. I think for more than a handful of contemporary ICOs, if you lost your money, you could get your money back.
This is the natural transition to the legal stuff.
Yeah.
But a point he brings up that I agree with that's interesting is that, like, I think what is the litmus test for what is it something a security or a commodity is if you can sue somebody and you invested in something on behalf of getting profits from that person, that person's work, which is the fourth prong of the Howey test. But I think beyond that, it's just, do you even have the ability to sue somebody? So in Bitcoin, you just don't have the ability to blame anybody for anything.
I mean, it might be useful for the crowd if you guys go a little bit in for your experience between the true cryptocurrency in the context of Bitcoin to what's evolved as the way to allow cryptocurrencies to arguably escape regulation of traditional securities, and go into a little bit of how, the building of the network and the use of the network at the time the token exists. And I think that would be useful to the crowd to get some practical experience on that before I,
so there,
cover them with just SEC regulatory.
There are three, we can go four. There are three distinct ways of creating a token right now. And so one is through mining, and so that's what Bitcoin did. Monero, Zcash, Litecoin, what else?
Yeah, those are
Yeah, the ones we would call cryptocurrencies.
Doge.
So that's the system that actually secures it, which are the miners. They get paid a reward in securing it or solving this math problem. So that's how all of the Bitcoin were actually come to being. Second is ICOs, and so that would be actually distributing these tokens, and so that's what's been going on a lot lately. The third would be forking existing networks, so Bitcoin fork, Bitcoin Cash. It took like a snapshot at a given time. After that, you own Bitcoin and Bitcoin Cash. Because the fourth you can say is airdrops, which is kind of like a fork in a lot of ways. That's just giving tokens to a new token to an existing address of a blockchain. I think it's kind of become clear in the legal lawyer world. I think I spend like 60% of my time with lawyers now, is that the ICO itself is an offering and it's kind of vanilla security. So like there was a party that offered something, it was very clear that they were doing work on it, that is a security. Then it gets to the point of enforcement though. And so it's at what point down the road can something that is a security turn into a commodity? Is there a point at which this asset, like the person who started it, is no longer responsible for it? And so I think there's kind of this consensus view that that's possible. It's just a super gray area of like, when is that? Probably the best example of something that may have achieved that would be Ethereum. And so the SEC has come up with pretty ambiguous language on how they think that is. So they've said every ICO we've seen is a security, but in the Dow report earlier last year, they referred to Ether, which was the capital raising fluid for the Dow token as a cryptocurrency. So they've kind of gone both ways. The mining part is much clearer that there's nobody really responsible for. It's distributed, so it's hard to say that there's somebody who's at fault for any problems in Bitcoin.
Unless you can demonstrate control.
Yeah, and so so Ripple, did Ripple have an ICO?
Kind of. Ripple's more like it.
So Ripple is like a distributed network now, but would be kind of in this gray area of, does Ripple, the company, have control over XRP? So there's XRP is this native asset of the Ripple network. Ripple, I think, controls like most of the nodes, or almost all of the nodes of the system. And so if you could sue somebody to tell them to do something, and then if they shut down the network, that's probably security.
Well, if any party, or even like a handful of people, can be unilaterally or multilaterally pressured to change the governance rules of a protocol, then the protocol isn't distributed, centralized. It's the same, it would be the equivalent of putting pressure on like Bank of America to institute a new policy. There might be a handful of executives and a couple of board members, you need to go like knock in doors, but if you can go do that, then that's a centralized institution. So for rewinding and compliance purposes, this might be interesting. I'm sure there's going to be lawsuits about this eventually, because establishing what control means is like a fundamentally probably a legal question. So, but
borderline philosophical.
Yeah, borderline philosophical, definitely legal. Because if you have the rights, wherewithal, or means to make a structural change to a protocol, that structural change can take the form of removing someone else's money, making it yours. It can be rewinding transactions or eliminating them from the database and bringing them back. Tether just did this. It means it undermines that premise, which Bitcoin holds, as the punctilio of honor, which is that private key ownership is ownership. And if that's not always true, then it means that someone has control where they shouldn't, and as a result of that control, it means you can put pressure, and if you can put pressure, you might have a legal case.
Yeah, like in the SEC's definition of like what is a security, pretty much they could put anything in a security, and then the U.S.'s the hand of U.S. enforcement is pretty much absolute, and they could do whatever they want.
I see Scott over there
Let's
trying
back
to-
up a second, though, because I think we're approaching this from the wrong angle.
Go ahead.
The entire reason for the Securities Acts in the U.S. were to protect investors, so they know exactly what they're buying into and what they're getting, and they have rights, and they can exert recourse on those rights if the situation presents itself. So when we're talking about the Howey test, we're talking about what's an investment contract, and that's the broadest test of what would be a security. And if you're a security, there's a whole lot of rules that apply to what has to happen before that transaction occurs when the issuer transfers that security, or it then secondarily transfers between holders. Lots and lots of rules. We don't need to go into that, but the question here is, should that apply to what we're talking about in token transactions? And in order to escape that, which obviously is the theme here, because otherwise you're really just dealing with another version of a security, you need to take it outside the Howey test and not make it an investment contract, which means you're not simply giving money to a third party and that third party is going to develop that business and you're going to profit from the development of that business, and the value of your token or interest, depending on what we're dealing with here, is dependent on the success of that company, entity, enterprise, whatever you want to call it. So what's trying to be achieved here as to escaping regulatory oversight is not tying it to the particular issuer of that. And you guys could probably give the example of Ethereum and how it's buying the computing power and what you're really doing. Because if you're using this token as something that has independent value, independent from the party that issued it, well, then you're no longer dealing with a security, because I'm not buying shares of a company, and if the company does well, I do well. I'm buying something that has some unrelated value that there could be market value placed on, much like gold as a commodity, where if there's more scarcity of gold, you're going to have an increased value in the gold you own. If these tokens represent something outside the success and the development skills of the people who issue it, well, then you've got a different kind of animal, and there's an argument that it's not to be regulated as traditional securities. And it's probably useful in that framework to give a couple of good practical examples of that. I'm sure there's a lot of creative ones.
Well, what I would say is that there's been some convergence on, I guess, legal best practices and issuance as well. And so now a lot of projects are using this SAFT framework, so Simple Agreement for Future Tokens. And so I think most people would agree that that is a security.
That's security.
That is security. And then at some point down the line, where this like centralized team is able to distribute enough, and then the actual token that was issued can actually do what it was intended for, then it becomes a commodity, or would just transition out of becoming a security.
Well, that in itself is tricky, because there's been some jurisdictions that have said this idea that it's a security, and then all of a sudden, boom, it becomes a utility, like doesn't work in their jurisdiction. So it'd be interesting to see kind of your thoughts. And then there's another one, another comment, that there's been over 10,000 ICOs, and only 1,200 of them have any sort of liquidity or are on exchanges. And so what happens if these tokens or securities or whatever they might be defined through these ICOs don't reach that point at which they're part of a network? Then what?
I mean, it's not an end-all be-all to be a security and not be a utility token. It's just like there will have to be exchanges that whitelist investors. There's just a lot more actual KYC to be done for the people who want to participate in. So, I mean, you're just limiting the amount of people who can participate, and therefore the capital that could be involved.
But you're drastically limiting it, because if you fall into security, you're either going to have to register it like you would a security. Think IPOs, which anyone who's ever looked through a prospectus knows what I'm talking about. That's not what the goal is with this type of cryptocurrency. Or you have to make out an exemption from that. So the typical exemption that everybody in this room knows about is accredited investors. So if you can make out a Reg D offering, and it's safe because it's deemed in securities law world that these are sophisticated investors and can protect themselves. They're not Main Street, mom and pop, widow and orphan type investors. So the SAFT model is, let's sell to these guys who we could, even if it's a security, sell to. There's no problem with that. We can make out the exemption. We can start the transaction, and then that contract is a promise that once we have the network behind this token, I think we need to probably go into what that actually means, then we can transfer it into that token. So even though high net worth bought a right to buy a token, they didn't buy that token. So that's not a security. They bought a right to buy it. Think of like a forward contract in commodities. If I think the price is going to fluctuate, I buy a contract in advance and say, I want this much oil at this price, and that's my deal.
Just kicking the can down the road then, right?
Well, you are, but in theory, by the time you get to the actual issuance of the token, it's represented by a network. And that's why I think it's probably, I don't know which one you'd say is the best example to use, but let's take a really simple one. Let's say a token gives you a right to get a movie ticket. So no one's going to argue that if I sold you a book of coupons for movie tickets, that I'm violating securities laws, right? You just bought this, and you go turn it in for movie tickets. But that means there has to be a network of movie theaters ready to accept it and to recognize it as value. And then if there's a scarcity of seats in movie theaters, well, the value of that coupon to get a movie ticket goes up. And maybe there could be an exchange developed where people exchange these coupons for the movie tickets. And now there's an independent valuation that happens. And now it's no longer the party that issued the coupon books. Who cares what happens to them? Now it's a separate currency in movie ticket coupons. I'm using a simplistic example.
There's a good example, if you guys have heard of CryptoKitties. CryptoKitties is, I'm not stating that it has any viable long-term value, but it's
kids
interesting
love them.
in that they did an ICO for these tokens. The tokens were basically digital representations of these cats that would, breed with other cats, and the output is new cats that have different characteristics than the two cats that started breeding it.
For like $100,000 or something.
Like the most expensive one did sell for like 180 grand. It's like this diamond crypto. I don't know. But from the movie ticket example, like you have something that has no real value other than I'd like to buy cats, and other people are like, hey, I want to buy cats because he wants to buy cats, and the next thing you know, everyone wants to buy these crypto kittens, and the structure evolves into a market where people find some kind of utility value in the breeding of and the appearance of these kitties, and then there's like an associated market with the pricing and the liquidity of such kittens.
So that example highlights to the greatest extent the gray area. I want to see a movie, I want a crypto kitten. So
I think a token that is pegged to a utility, like in the real world, I think that's pretty vanilla. That's like a utility token. Just very few people are doing that because that doesn't have like the network effects or like the sexiness of like everybody can make a lot of money.
Yeah, you don't get that bootstrapping.
Yeah. There are, so really besides like Bitcoin, Ethereum, and like the other cryptocurrencies, there are a few decentralized applications, like very, very few that are functioning, and really the only class that is decentralized exchanges. And so a lot of these decentralized exchanges have issued a token, and that token is used for fees on trading on that platform. And so that's probably a pretty good example of something that's not a security.
So now to really get into the really dark area here. So how many of you have heard of Petrol coin that just came out? They raised $700 million, and while I don't know if I would buy a coin issued by the Venezuelan government, one of the things that people talk about is the fact that it was raised as sort of as a debt instrument, and one of the things that we've seen with the SAFT is that it has generated these cousins that sort of look like the SAFT, but they're not really the SAFT. So I'm just wondering your thoughts in terms of the sort of direction in the future. How many sort of cousins? Not saying that they would be issued by organizations such as the Venezuelan government, but how many sort of iterations or other instruments do you see the these type of coins producing?
Are we talking about like nations issuing more, or is the general?
They're looking to use that as a mechanism to bypass their decreasing currency. So it's kind of like an exit ramp.
But guys, do you think this could at all help? Because the entire reason these systems are set up is to take away the influence that the government could have on the value.
See, I would say I started in all this. Like I think to get interested in Bitcoin in 2012, you had to have like libertarian leanings. I would still say at least. I would still say I have that, but I've become like a lot more pragmatic. I think I don't think local currencies go away. I think what happens is like what Bitcoin's value ultimately is decentralized store of value, and so like that just limit like the Fed can't do monetary policy because like the dollar currently right now is both a medium of exchange and a store of value, and so like I think I don't think local currencies should ever go away because the medium of exchange is an important social contract for people living in like a locality, and so that's also a way of just keeping track of how things. It's a way of account. But in terms of like just stepping back, I think everything is going to become like digital or like put on a blockchain per se. So like the SEC will likely have like it's just a much more efficient way of of keeping account of things. And so, like, and I think where most of this tech goes is probably for cost-cutting purposes and not for this, like, sexy currency that has network effects. And, like, it's kind of like internet versus internet, but I think even a lot more, like, I think the infrastructure of blockchain most of them should not have a native currency, but the ones that do work will be very valuable.
It's interesting you should say that, because are you familiar with TZero?
Yeah.
Patrick Burns. So for those of you who don't know, he was at Overstock, and he had a situation with his IPO in which I guess there were a number of phantom shares that affected the price of his stock, and he had some concerns in terms of his who was offered opportunities with respect to his securities, and so he decided to launch TZero that actually creates a one-to-one relationship. And for those of you who don't know, in settlement and trading, there's sort of a netting effect. So while you talk about the certificates on dollars, in which, I'm not going to get into fractional banking and all that stuff, but in the securities world, it's not a one-to-one relationship. It's a netting effect. And so once again, this is sort of a representation of new derivative ideas of using the blockchain and tokens as a mechanism to track that double spend or that change of state. But just wanted to get your thoughts on that.
Yeah, I think what's interesting about TZero is the infrastructure of it. I'm not really sure what the native currency.
It's
So
just
like
applied crypto. There's no currency.
so like we didn't invest in it, but it's really interesting that like they will kind of have this war chest of investors and like really brand name like legacy real world investors behind them. So it's almost like guaranteed to succeed in that way. But yeah, what that I think is what's doing that's interesting is implementing a lot of this technology on making like exchange more transparent. And so a lot of these guys were kind of screwed over in 2008, 2009, like very notoriously Goldman like screwed over a lot of people kind of and chose whose accounts to honor. And so there's always been these exchange problems of, like Michael Lewis talks about this as in Flash Boys of kind of the broker running ahead of trade. Like the investors just want a more transparent field to play in.
That's my son.
Has an opinion about this market too, huh?
Johnny,
Taking that question?
Johnny does know more about the exchange check than I do, so I'll
Yeah, so basically Exchange Check really hasn't been upgraded since Cobalt was invented, which if any of you remember that, was like in the 1980s. That's when it really was popping off in the financial industry. So there's a massive fintech opportunity to use applied cryptography to upgrade these systems. Those are separate from blockchains because blockchains are, again, a methodology for enforcing conditions amongst competitors who sometimes have to be counterparties.
But if you don't say blockchain, it's not that cool.
But if you don't say blockchain, it's not cool. So you have to talk about it. But essentially all companies like TZero and a handful of other ones, unless they're getting independent institutions with different backers, different board members, different independent governance protocols over their own institutional rules and their own capital internally, to work and adhere strictly, almost religious, actually more than religiously, they have to adhere to the laws of the system more. They have to adhere to them even more so than they have to adhere to actual laws. Because in actual laws, they can whinge or skirt or bend it and then just pay fines later. But in a mechanical governance structure, you can't bend the law. You can't bend the rules. The rules are the rules, and if you try to do something that's outside those rules or bends the rules, it's just an invalid state. It won't permeate. It's not a transaction. It's not real. It's not legitimate. Whereas for in a classical structure, and Goldman's a great example here, they can bend the rules based on their whims because paper trails and in-person and handshakes and things that occur outside of the mechanical systems that they operate in, because the mechanical systems were built in the 1970s. So what you're not seeing right now, you'll see some like super higher order, like companies like Ripple, companies like where did Mike Hearn go again? It was Corda, the R3 group.
yeah.
Oh, you get a bunch of like VP level peoples at banks all come together and be like, oh, we're all going to do settlement and stuff amongst ourselves. No, what's actually happening is they're building a parallel database for their current databases that run in Cobalt or otherwise, and they just run both, and then they just pick the one they like that runs between both. There's no like adherence to like a religious rule set or a mechanical rule set or a new governance structure. It's just they're running both of them.
Actually, the incentive system is often missing as well.
Yeah, so because in a lot of
Yeah.
cases there are incentives. It's like if you were to, if for example, all the investment banks were all to agree to adhere to a new strict mechanical rule structure for how they do business with themselves, it would be like asking them to select, probably year by year, which one of them is going to lose a leg. And no one's going to agree to join a group where maybe by lottery or maybe by selection of their larger and more aggressive peers, who's going to start losing limbs because next year now you don't even have a leg. Now you can't run away as fast. So there's a weird incentive, so almost perverse incentive break where convincing these corporations and these institutions to participate in these new mechanical structures isn't there because to do so would undermine their businesses they make money on now.
Yeah, the investment banks are the best. I mean, the smartest people in the world, really, and the best at thinking economically. And so, like when like the Goldman kind of chose whose contracts to honor, like during the financial crisis, like they knew they were going to be paying a fine down the road.
Yeah.
And so it was just like the money managers were the ones who like, fell on the sword for that.
Yeah.
But so it's like this is fundamentally being driven by now money managers and not kind of the infrastructure or the existing infrastructure.
So we're running out of time. So I was going to finish with one last sentence from each of you. And once I said we're running out of time.
I'll comment on this a little bit. So it's anecdotally, what you can find, because I've been at the investment bank for some time, I guess, but what you find in investment banks is that they all like the blockchain kind of technology. They get that, but then the question is a little bit so, but where do I go to when it goes wrong, right? So there's this mentality that people might have that, as long as there's someone responsible, I have some kind of recourse, but that's not always the case, right? So if someone hits the red button and nuclear bombs go to North Korea, then and with a nuclear war, there is someone responsible for it, but the recourse is useless, right? So that's in general what I find that in investment banks people have the hardest time with is that, there's no one to go to. I can't go to a central bank, I can't go to the clearinghouse, I can't go there. It just does it itself.
So to recap, I'd like to ask each of you to give one brief phrase in terms of what you see for 2018 or what is needed for 2018 to make this market investment friendly for the institutional investors. Let's start from the set.
I don't know the phrase. I'll make it as short as possible. I think where we currently are right now is like people fall into one or two sides and you have very few people in the middle. It's one, I think most people still just don't know what's going on. So I used to think that like the custody and regulation were the two largest hurdles for getting everybody interested and involved in the space, but I really think it's still education. So you have that one person, and then two, you have the person with a higher risk appetite who's completely jumping full on and like owns 100 different tokens. And so you have just a massively irrational marketplace right now. There's I think how you succeed in this in crypto is like being at the 97th percentile of risk appetite, and not like the 98th, 99th, or 100th. So like pulling people back from like the 98, 99 is I think where we need to go this next year.
Hey, so Johnny, what are your thoughts?
So it's a pretty big question, but I would say first, I think a lot of people need to lose a lot of money. A lot of these ICOs, a lot of these altcoins are going to go to zero. It's not really clear which ones or why. A lot of it has to do with liquidity. A lot of it has to do with the fact that the coins themselves are useless or provide just glorified spreadsheets. And no one needs a glorified spreadsheet. We've had Excel for like 40 years. So I think that's one. I think two, I think banks kind of dipping their toes in this kind of idea that they might be able to custodialize Bitcoin or some of the other bigger coins would be a really big deal. And I know a couple of them that are thinking of doing it. And the first ones to do it will make a lot of money because people are looking for a counterparty, despite the fact the system's supposed to not have counterparties. Ultimately, I think the third, and this is probably a little bit radical, but I think further weaknesses and evidence of the long-term collapse of the modern financial system as well is probably really good for Bitcoin. This is just
Just leave it-
Great
leave it
for
at
the
a
rest of
hedge.
us, too.
It's a good hedge.
Good angle.
Okay, Renee.
Yeah, I think it's still pretty difficult to sort of buy these coins and participate in ICOs. It would be good to see sort of the wallet technology get a bit easier to use and things like that. Also the interface with fiat, and because I do think we still have dollars for a long time, if nothing else to pay taxes, because the government still control that part. Right?
Definitely.
And you live here, so you have no choice.
Not in Puerto Rico.
No, in Puerto Rico. Yes, that's true. So I think sort of the interface between fiat dollars and cryptos would be good to solve that a bit better. You know, you have a lot of concentrated counterparty risk in Coinbase and a couple of these exchanges cracking down for 4 days, that kind of stuff. It's not very comforting for real investors to come in that have money.
I would echo, I think that custody is going to be a big, hopefully, solution this year. Yeah, solution this year. Like these guys said, I think there are a lot of people that are investing in it, and I think that we probably will see something come around. That means when custody gets solved, I think institutional money will start to kind of come in at more of a pace. I also think that there are more. I think a lot of the exchanges need to kind of grow up and mature. From our perspective, it's incredible to see how unsophisticated and non-standard they are.
These are websites, not exchanges.
Right, they're just market makers.
For a lot of them, yeah.
Yeah, they're simply matching buys and sells.
Technologists, and now we have like our first wave of like finance people.
Right, so I think with all of that coming in, I think you're gonna see a boom, but I think there's gonna be a collapse probably before.
We've had a little bit of a collapse.
I think
Bounce
it'll
back.
come as no surprise to anyone. I think we need to have clear regulations. Before institutional investors get involved, you need to know the rules of the game. And right now, the SEC is basically just scattershot, sending subpoenas to funds to find out what their activities are and what they're investing in, and they're trying to collect data. The end result, I assume, is a set of rules so that everybody knows how you play the game and how you are truly not a security. If you are a security, you're following the rules. So we bring everything in line. So once the game rules are set, I think everything will move forward, and institutional parties will loose up the purse strings and get involved.
Yeah.
So now that we've really dug in and sort of taken the shine of this really frothy, discussion, we're going to open it up to Q&A, and wanted to know if anybody had any questions. First.
I'm curious to know your thoughts on stablecoins, Basecoin, and other solutions to the stablecoin.
Use the U.S. dollar.
Yeah.
Actually, having stablecoin is pretty useful given that Bitcoin trades 24/7, right? And if you're on Friday or Saturday at 5 p.m., you want to say, I don't want to expose the Bitcoin.
Yeah.
What do you do?
So
I
I
buy Tether, I guess, and everybody agrees it's worth $1, but it doesn't mean anything.
But I mean, again, so ultimately it has to do with who your counterparty is, because if you're gonna establish that something has a fixed value, it means someone's underwriting that fixed value, which means you've just recursed to the exact same problem these systems were trying to avoid in the first place.
So I've met with most of the teams working on these stable tokens. They're really smart guys. I think it's like fundamentally what it is like engineers trying to over-engineer a solution though. So like really the best. So I think long term, I think Bitcoin I think Bitcoin becomes the stable kind of crypto asset. So there's a market for something that's stable for exchanges from here until now, and so they're definitely, like Tether has definitely showed that there is a adjustable market for that. I think really the best way to do that is by pegging it to something that's stable off of the blockchain, to try and over-engineer something that moves pieces along. You essentially have an infinite attack surface for things to go wrong, and so like when they're going to go wrong, they're going to blow up in a very dramatic way.
Yeah.
And like what we've learned in the normal financial market is anytime you have a complex derivative or just a complex financial product, it gets blown up in a very dramatic way. So
You'll ultimately lose, catastrophically.
But just a follow-up, I'm sorry, but certain exchanges won't accept fiat currency. So as a mechanism to transfer value from one exchange to another, does this obviously?
I mean,
John, you
so
don't make that
you can, I mean, where the tech is going right now, like with Lightning Network, you'll be able to, I mean, you can move assets like Bitcoin, like Ripple, whatever, pretty quickly from address to address. And so in terms of so what risks are you taking with holding assets? So there's market risk, and so like exchange risk. When that can happen instantaneously, there's really no need for that as much as well. But like really what like a stable token is used for is mostly for leverage. And so that's using for trading on margin. And so you kind of so that's like Tether's had an addressable market for that because people do that. And it's this addressable market's pretty much like gambling. So yeah, I do fundamentally believe that stable tokens are needed for closed systems, and you could do really good in a closed system because there's known variables that impact it. As soon as you're opening it up, which all of them are doing, like things can go wrong in so many different ways.
Like we had this debate in 2014 about application tokens. So one, if you're talking about stable tokens, if you're an investor, you have no incentive to hold it until the moment you need it. So it's similar to like moving in and out of US dollars or moving in and out of Bitcoin even. It's like unless you have an incentive to utilize it, you're not going to hold it. So anyone who's actually running that system, how do they make any money? First off. Second off, for example, for a group of exchanges, and I worked on this with the Strong Federations technology, sure, you can have everyone agree through legal constructs and legal systems that they're going to have some unit of value that they bank or that they hold somewhere in a system. Maybe they have a ton of gold or something, and they all agree that like that can be used and unitized amongst the group. But fundamentally, there's counterparty risk there. So you subject yourself, and as you make that more synthetic, you subject yourself to increasingly higher orders of risk underwriting because of your underwriting party, the counterparty itself, and fundamentally the cost and the risk metrics eventually make it so that it doesn't matter that it's a stable coin because you're still taking risk when you get into it. It's only stable in the most like surface of ways.
One more question. How are we doing on time? One more question? Okay. Sir?
Sure. For coins based on mining, how much is the value anchored on CPU advancements or math advancements? CPU efficiency goes up 50%. What happens to the value of currency?
I mean, it's I think a very complicated question because like the incentive mechanism.
Yeah, it's a second order effect.
Yeah.
Well, I mean, you're dealing with like miners by definition, like they're perfectly competing, and so like the fee-based system. So like a Bitcoin, the fees that are paid to them, one is from a mining reward, which will go away eventually. Then two is fees, and so that's just based on supply and demand of the network congestion, and so. You have that part of it, so the network congestion, which is solved by miners, more miners theoretically coming in. Like there is this perfect competition balance that's reflexive that constantly just solves for that problem. So what could be an issue is just the centralization aspect of miners. It's like the only thing to be concerned about.
Like the question that deals with two components for Bitcoin and for some of the other coins as well, but it basically has to do with the characteristics of the distribution of the system, both in the short, medium, and long term, and the security topology of the network as a result of the change of the new technological era. So when we're talking about Bitcoin, we're way past, like we're shipping chips now that are like 12 and 11 nanometer. So like for Taiwan Semiconductor and Global Foundries, like I think a third of their current process nodes are almost all Bitcoin chips by this point. So we're actually at the actual bleeding, way past bleeding. Like we're at like the micro edge of Moore's law, micro edge of silicon. So it's not we don't really get the kind of massive improvements we got in 2014, 2015 anymore. You get like 10 or 20% from shipping a new process node. But I think about the value, it's probably a second order effect in that the total computational power underwriting a coin is essentially a proxy for its security, for how difficult it is or how costly it's going to be for you to rewind history. So it's like a proxy for how difficult would it be for like a government to decide they want to unwind a transaction from a day ago. It's a good example.
So I think we're done at this point, right? Or is it time for one more question? Okay, two more questions. All right. Young lady over there on the left. No, it's you.
So can you guys draw a parallel? I think this might be interesting to see the audience. Talk about value creation in traditional startup world, you know, pre-IPO versus post-IPO. If you draw a parallel with the pre-ICO, who's right now having the most value? Is it founding? Is it actually ICO advisors? Is it, you know, pre-sale people? Is it sale people? Is it post-ICO people?
Good question.
We're gonna talk about that.
Good question.
I'll try. Yeah. I think the ICO is just finally starting to converge into like the similar characteristics of an IPO, and so like now what's typical is like they'll sell like 20% of the network. Like it's very similar to like how IPOs work. So they will sell like 20% of the network. We'll like price it at like a slight discount to try and attract follow-on investors into the actual market. We'll keep tokens locked up for the founders and advisors or just general insiders, and so like it's starting to converge to like how like the IPO process has been like perfected over like 200 years or whatever. So it's like to throw that away, which was happening. It's like throwing like just what works out. Yeah, so like I guess that's kind of happening. How else is it? I think like what's concerning, and I think so. This is this SAFT market now, and then moving into ICOs, which is mostly actually happening in China now. What's concerning to me about what's going on right now is that you have massive amounts of people that are interested in the SAFTs and getting in before the ICOs, and not too many people interested in the liquid market, and you just can't have them even like find listings on it. So like this SAFT pre-ICO arena, I think has become like a hyper bubble, and I think that's probably going to continue. It's been like the space now really where only institutional money can play in, and so like VCs like by nature like just probably can't buy liquid tokens and custody them. Like they can't spin it to their LPs, number one. Number two, like it's the custody issue, it's hard to figure out. Also not in their wheelhouse to deal in liquid markets. But like investing in an early stage tech and then like getting and being able to sell that whenever is something that they can do. And so you see like institutional money like coming in waves into the SAFs, and so like the Telegram ICO is the best example, is like valued just based on like 129 paper at like $2 billion. So I think that's probably going to continue for a little bit of time, but hopefully that answers that.
So one more question, sir.
Yeah, a quick question about how people are accounting for the funds raised through an ICO. I'll give you two quick, small examples. Actually, conversation I had with different lawyers in the last month. One was a company, small company, $500,000 raise that raised $32 million in ICO at a P&L company. And no one could figure out exactly how they should book that money. Is it revenue? How does that accrue back to the value of the company? Another company is a U.S. affiliated company that raised more than $75 million in ICO in Switzerland. They've been trying to repatriate that money back to the U.S. And they've had a lot of difficulties in figuring out exactly how to do that.
Well, one of the bigger issues is the KYC AML, that a lot of these ICOs didn't figure that out ahead of time, and so they're sitting on a lot of ether trying to figure out how they're going to pay their bills or move the money around. And so that was a little bit of what we alluded to in the beginning in terms of, you know, does that money ever get accepted into funds? So
like what you have is most ICOs just being raised in ether and then just not doing anything with that. So they can't get a bank account to then trade the ETH into, so like, I mean, really ether is like, or the Ethereum blockchain has pretty much become like a capital markets platform. And so like, that's where its main like function is now. And so you have just a lot of projects who's raised and you really can't do anything about that. Like, I'll let the lawyers in the room speak where I'm not qualified. But
I think for a lot of them, they're avoiding the pitfalls by just attempting to do it inside Reg A or Reg D, just Jobs Act methodologies for raising funds via accredited or sophisticated investors. A lot of others are probably going to have problems, but I know a lot of Canadian ICOs, a company I advise Crowd Machine's doing as well. It's a product. You think of it as the same way as that Tesla sells pre-slotted allocations to the use of their factory in the future. The factory produces a car, you pay for the car upon its use, and the car is delivered. It's just you've pre-purchased a product that's going to be delivered to you.
So I mean, just technically that becomes prepaid revenue.
Yeah,
yes,
it does. Yeah,
And that's a big problem to take into account, because this is one situation where the party that's originating the currency would almost rather be treated like a securities. There's no tax to the company when they raise money from the sale of equity. Well, if you do tokens on exchange for products, well, you're going to have revenue and you're going to have to pay taxes on day one, see where the company goes. But that's a completely different paradigm from what you'd have in the equity raise situation. So it really doesn't mesh together well.
If you're raising a utility token, like that kind of is like deferred revenue and should be booked as revenue. And so what's the taxes on that? Then it could be like 50%.
Income tax.
It depends on where it comes out of. It could be like, depending on where you are, it could be like 50%.
And
Or as low as
Sanjay, you also know that the country of origin of each of the issuances you're talking about also indicates, probably the likelihood of success of those ventures under the U.S. markets in Switzerland and the Cayman Islands. So there's a reason they're there.
So it's not as simple as it looks. So for those of you that were thinking, oh, I wish I'd bought Bitcoin in 2000, whatever, security is one of those unappreciated aspects of it. And I always tell people that if you did buy it, you probably wouldn't have been careful with your keys and you would have got a Trojan and lost it. And so you're better off not having purchased it in the first place. So, there has to be a level of appreciation of how difficult it is even just to hold on to the coins that you purchase. So, but the panel has been wonderful. The question